Right, what's going on, everyone? Hope you're all doing well. So today we'll be moving on to lesson 4, where I'll be going through market inefficiency, other words, imbalance, fair value gaps. They're all the same thing, just different names. So let's get straight into it. Market inefficiency. When looking at efficient price action, we notice that all wicks meet. What it essentially means is that when price is moving over to the upside, both the buyers and the sellers have a fair chance at access to liquidity to continue the wave up. Now, if you take a look at inefficient price action, we notice that wicks don't meet. This therefore means this move had a lot of buying power, which has created that imbalance. So, let me show you an example here. Inefficient price action. In this case over here, we can tell that there has been a lot of selling power. Why? Because the wicks don't meet. Whereas this example here of efficient price action, when price is moving over to the downside, we know that there isn't too much selling power because the wicks are meeting, right? So this is the first wick and the third candle. This is the first candle and this is the third candle. The third candle's wick, if it meets the first one, that means it's efficient price action. But in this example here, as you can see, the first candle's wick, it doesn't get met by the third candle's wick. There's a gap. That gap is what we call imbalance, inefficient price action, fair value gap. They're all the same thing. Now, in a bullish scenario, there's a lot of buying power in this case here. So the first candle's wick doesn't meet with the third candle's wick. This creates a gap, an imbalance, or fair value gap, inefficiency. In this example here, market is moving over to the upside. However, the candles are meeting. This therefore means it's efficient price action. There isn't any imbalance, right? So now if I go back and I read over it again, I hope it makes sense. So when looking at efficient price action, we notice that all wicks meet. Just like the example here, efficient price action, the wicks meet, right? Now what that essentially means is that when price is moving over to the upside, both buyers and sellers have a fair chance at access to liquidity to continue the wave up. Now, if you take a look at inefficient price action, we notice that the wicks don't meet, just like the example. The wicks don't meet, right? This therefore means that this move had a lot of buying or selling power, which has created that imbalance. However, when you identify inefficient price action, keep in mind that price comes back to fill in any imbalance, to provide both the buyers and sellers a fair chance at liquidating the market. However, this does not mean every imbalance will always be filled, okay? Keep that in mind. Now, if I head over to some examples right here. What is this? Imbalance. Why? This wick did not meet with this wick. Therefore, there was a gap, an imbalance, inefficient price action. But notice when price starts moving over to the upside, when it pulls back, what does it do? It pulls back to fill in that gap, right? Now this is what we classify as efficient price action because this imbalance has now been filled. Makes sense? So when you identify any imbalance in the market, expect price to pull back to fill in that gap, right? Now look at this example. What is this? Inefficiency, right? This is an imbalance. Why? This wick did not meet with this wick. So expect price to pull back to fill in that gap, right? So notice how price pulls back, fills in this gap before it continues over, right? So efficiency is quite straightforward. There's not much to it. It's simply when the wicks don't meet and there's a gap created. This therefore represents that there's a lot of buying, in this case, a lot of selling pressure. So when price wants to pull back, it will fill in any imbalances. Right? I hope that makes, and I'm going to quickly show you guys an example before I move over to lesson 5 because this is fairly straightforward. Now GC, this is one of the trades that I sent over on the Discord, right? Now, in terms of this entry here, what do you guys notice here? Okay, so let me remove this order block. But look at this. Look at this wick. Let me zoom into that. This wick and this wick don't meet. So what does that mean? That from here to here, all of that is imbalance, right? There's a lot of buying power. What is this? imbalance. What is this? Imbalance. This imbalance, again, pulled back and it got filled. But there's all of this imbalance down here and here that needs to be filled, right? So, when price moves over to the upside, right? What do we expect price to then do later on? We expect it to pull back to fill in these imbalances, right? And look what it does. It pulled back and filled in that imbalance. But there's still imbalance down here. And there's an order block that's left unmitigated. Now, this is what I want to now make you guys understand. When identifying an order block, you look for an order block that has imbalance above. This therefore means price will pull back to fill in that imbalance and then mitigate our order block. So essentially, I now have identified that there is imbalance at this area. And we have also identified an order block, right? So now what do we expect price to do? We expect price to pull back to number one, fill in this imbalance, and number two, mitigate this order block. And now if I stretch everything back, what do we notice happened here? Price has now impulsed and pulled back to fill in all of these imbalances, right? And then what did it do? Mitigated our order block. We now go long at this point over here. Oh. And in terms of TP, we'll look back for any liquidity and we can clearly identify a double top right here. So in terms of TP, you'll target that high there. Why? Because there's liquidity, right? Now, in terms of this re-entry here, very straightforward. What is all of this here? This whole entire area from there to there. Imbalance, right? What was this here? From this wick to that candle. Imbalance. But what happened? Price pulled back. It filled in this imbalance. But what's here? More imbalance. So, when price pulls back, it filled in that imbalance, right? And not only did it fill in that imbalance, it then mitigated our order block. As you can see, price tapped us in, we move over to the upside, right? And more examples right over here. This move here, let me remove that rectangle for you guys. This wick didn't meet this wick. So what does that create? Imbalance, right? So we now know from this point here to that point there, price must pull back to fill in that imbalance. And it done that right over here. Now, in terms of mitigating our order block, it pulled back to fill in the imbalance, but it didn't mitigate our area of demand. And what do we expect? Price to pull back, mitigate that demand, to then continue the move over to the upside. And let me go show you guys further examples. AUD, NZD, right? Perfect examples. Right over here. Head over to that 30-minute. What do we notice? Let me remove this order block for now. This candle and this wick, imbalance, right? The body, the close of this candle, sorry, the open of this candle and the wick of that candle don't meet, right? So what does that create? Imbalance. Now once we have identified that, we now know when price pulls back, it has to pull back to fill in that imbalance. Now not only is there imbalance, we identify an order block right here, right? An unmitigated order block. So we now know when price pulls back, it will pull back to fill in all of these imbalances, right? As it does, all of these imbalances are now filled and it has mitigated that order block. Does that make sense? And now another example over here. What's this? Imbalance. And now what do we notice price is starting to do? It's starting to pull back. We expect it, this is current price action right now, and I'm looking at this area to then sell off again. So we now expect price to pull back, fill in this imbalance, mitigate our order block, to then continue the move over to the downside. One more example. Euro pound. Head over to that 4 hour. Let's stick to the 1 hour. Now let's go to our initial entry. Why did we enter? It's fairly straightforward, guys. Look, 1, we had that break of structure. 2, what is all of this? From this wick here to this wick there. What's all of that? Imbalance. Now when price pulls back, we expect it to pull back all the way here to fill in this imbalance. But what do we notice up here? A clean order block, an area of demand. So not only do we expect price to pull back into that area of demand, that imbalance, we expect it to mitigate that demand before continuing over the move over to the downside. It's fairly straightforward. The understanding of imbalances is clear. All of this here, look, this wick did not meet with this wick, so price pulled back, filled in all of that imbalance. Yeah? This area here, this wick did not meet this wick, so price pulled back. Yeah? This wick here and this wick and this wick did not meet. It created imbalance. What did price do? It pulled back, filled in that imbalance, and then continued. Right? It's fairly straightforward. Now let me see if I can show you guys one more example. Perfect example right over here. Look, this wick and that wick up here, they don't meet. So what does that create? Imbalance. So what do we know? Price must pull back to fill in this imbalance. And look what it does here. It pulls back, fills in all of that imbalance. And not only does it fill in that imbalance, it comes to mitigate our order block, to then continue the move over to the upside. Does that make sense, guys? Now, look here. Is there any further examples? Here. This wick, that wick, they didn't meet, but this candle here pulled back, filled in that imbalance. Let me mark that out. Wick. Oh my god. This wick to that wick. They didn't meet. So what did this candle here do? Pulls back, fills in all of that imbalance. Yeah? Hope that's straightforward, guys. Let's see if I can find you guys more examples. Euro JPY. Perfect. I'm currently in this trade right now. Now look at this. This wick here and this wick there. They don't meet. What is that? Imbalance. So we now know price will pull back to fill in that imbalance. And what do we have over here? An area of demand, area of supply. Price pulls back into that area of supply, fills in that imbalance, and then continues the move over to the downside. Now, why are we selling off? What do we have here? More imbalance. So price has to pull back, fill in this imbalance. What do we have here? More imbalance. Price has to pull back to continue filling in these imbalances. I hope it's straightforward. Now, in terms of my re-entry, it was on the 3-minute. But why did I take this re-entry? Let me show you guys now. Now, when I sold off here, price broke structure. Once we got that break of structure, I started to look for re-entries. Number 1, we have an order block. Number 2, look at this. Imbalance. We now know price has to come back to fill in this imbalance and mitigate that order block to then continue the move over to the downside. Now, I hope that makes sense. What do we have here? Imbalance. This wick and this wick don't meet. But what happened at this point here? Price pulls back to fill in that imbalance to then continue the move over. I hope that was fairly straightforward, guys. If you have any further questions about imbalances, feel free to message me. But that will be it for this lesson. Now I'll see you guys in the next lesson. Take care.